welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Thanks for joining. If you're in a traditional balanced portfolio, that is 60% in equities and 40% in bonds, you may not be thrilled to see both asset classes take a hit in today's environment. Well, that's where investing in alternatives can play an important role to help lower the overall volatility of your portfolio and improve returns. Jeff Shell is the head of alternatives, ESG, and innovation at BMO Global Asset Management, and he joins me now to share his insights on this space. Jeff, great to have you on.
Thank you for having me. Wonderful to be here.
So, Jeff, when we talk about asset classes, we typically talk about stocks and bonds, right? Those are the two that come to mind, at least for many mainstream investors. And yet, alternatives, even though they're less known, it's a huge asset class in itself, and one that a lot of people may be investing in and not even know it.
Yeah, that's absolutely right. When you hear the term alternatives, it gives people the impression that it's some fringe part of the investment portfolio, maybe a fringe part of the economy. The amazing thing is that it isn't. It's actually the dominant part of the economy. Like if we look at the US, for example, and you look at the companies that have over $100 million of revenue, 90% of that value is in private companies that aren't publicly traded. So to refer to it as alternative is kind of skipping the reality or sidestepping the reality that it's in fact the dominant part of the real economy. And although, as you mentioned, people may not be aware of it, in many cases they are in fact already investors in alternatives. If you own real estate, if you own collectibles, if maybe you're an investor in wine or you've got a sports card collection, maybe you hold jewelry. All of these private type investments, things that aren't publicly traded, really ought to be thought of as part of your alternatives investment portfolio.
Yeah. So, Jeff, can you talk about a little bit about the correlation piece? Because, one of the golden rules in investing is you should diversify your investments, right? By picking assets that aren't highly correlated to each other. So how does alternatives fit into that?
Yeah, one of the implications of being publicly traded is that the movements of the market are going to end up driving a lot of value. So if you've got, for example, a real estate investment that's a private real estate investment, the way that it's going to be valued is according to how it's performing, whether that property's become more valuable, whether the rent rolls have increased. That same investment in a publicly traded vehicle is going to see 60% or so of its market changes explainable by what's happening in the broader market. So the same type of investment packaged in a public form versus a private alternatives form ends up resulting in very different outcomes for investors. And investors really do need to be thinking about how can I manage the risk of the portfolio? How can I minimize the amount of volatility? And how can I maximize the amount of capital appreciation? So hopefully this real estate example is one where you take exactly the same asset and you put it in a different format, and the value is going to be quite different, and the impact on the portfolio is going to be quite different depending on that.
Yeah, that makes a lot of sense, Jeff. One of the challenges that we are seeing right now, as you heard in my intro, is bonds and equities are down right now, and typically they're not highly correlated. Obviously, different factors affecting both. The other challenge that investors are facing right now is trying to find yield in a rising interest rate environment. So what type of alternatives could make sense for them?
If you're looking for yield, the alternatives that would make the most sense are ones that we refer to as the core part of the alternatives portfolio. And that could be investments in infrastructure, it could be investments in real estate, it could be investments in private credit. And when I say private credit, I effectively mean loans. And so it's actually, the performance of those assets that end up driving the yield. It also ends up driving the valuation. So to an investor, you could get really stable income, and then you can also maybe decrease your exposure to public markets and the impact that they can have on your portfolio.
Okay. We only have about 30 seconds for the break. So you mentioned real estate, you mentioned infrastructure. They're typically, would you say, stable and for people who are looking sort of long term?
Exactly. When you think about infrastructure, they're often very long-term contracted cash flows. So it could be, a power type arrangement that is generating stable income that investors could benefit from, um, yeah, which would provide a strong level of income through the cycle.
Okay, makes a lot of sense, and why we see a lot of pension funds put their money in it. Welcome back. Jeff, before the commercial break, we were talking about pension plans and how many pension plans actually invest in alternatives. Can you talk a little bit about that and why it makes sense?
Yeah, pension plans and institutional investors more broadly really started the movement towards alternative investments. And this was a number of years ago, starting off, they call it the Yale or the endowment model. And really, what they did was that they looked at their obligations and they looked at their obligations over time. And they came to the conclusion that they can take more of a long term view because they have a predictable series of outcomes that they're working towards. So, whether they're insurance companies who have modeled their liabilities and they think we're going to have payouts at certain times, or endowments that are looking to achieve long term objectives, that long term thinking allowed them to invest in a very different way. And as we look at families these days, and families are thinking about, do I have the assets that I need to fulfill my financial obligations the way that I
Hmm.
want to live the way that I want to live? If they've got excess capital, that then allows them to think more long term in nature. They can think about, what do I want to leave to the next generation? What are the causes that are most important to me that I might want to make sure that there's capacity to help support? And so that portion of capital that you don't need in your portfolio, that's a portion that you can really think about making more long-term investments, and that fits really well into certain types of alternative investments, like private equity or venture capital, where you could be putting money in today with the expectation that you're going to get that money out 13 years later, and there's going to be a whole lot more for you then than you put in today.
Okay. So, Jeff, for those watching it and wanting access to it, how do they go about doing that? Is it through an advisor? And if so, what are the questions and what do they need to think about to make sure they're picking the right advisor and making sure they're picking the right type of fund?
I, Getting into alternatives is something that advice, whether it's an advisor or a counselor, I think it's very important to have a guided hand take you through. Because you don't want to be making one or two types of bets. What you want to be doing is thinking about your entire portfolio, what you want to achieve in your portfolio, and where do alternatives help you achieve that in a beneficial way. And uh, depending on whether you're looking at the income that we talked about earlier, increasing the income predictability in your portfolio, in that case, manager selection is less important, but you do need to make sure you're dealing with a trusted manager and you're investing in a fund that's well constructed. When you're thinking much longer term, like the 10, 13-year private equity or venture capital investments, that's where manager selection is really essential. A great manager is going to outperform a good manager by a huge amount. Less the case when it comes to the income part of your portfolio. But I
Hmm.
guess all this is to say is you really need to think about your objectives, how your portfolio is constructed, and an advisor is a great way to better understand the space and ultimately enter it in a really thoughtful way.
Okay. I want to turn to ESG because that's an area you're also looking at. How does ESG and alternatives tie in?
So ESG in public markets is it's become a very important part of public markets investing. People are putting their money more in companies and in sectors that they think are very important to them that align with their values. One of the really special things that you're able to do in private markets is that you're not investing in necessarily just in companies that you like. You're able to make direct investments, like to enter an infrastructure fund that at the margins is going to take your money and use that to maybe buy a solar panel. And so you really see a direct connection between the choices that you make in a private markets investment
Mm.
um, versus a public markets where maybe if you provide extra money or you invest in a company that makes solar panels, that may be helpful to them, but it's not going to result in the real outcome of more financing being available to buy that next unit and to really have a tangible impact on the things that you care about.
Oh, that's really interesting. We only have about 20 seconds left, but so that means they can have a more direct impact.
Very well said. They can have a more direct impact through private markets in many cases than they can through public markets.
And it would it be transparent? They would know what they're investing in that way?
Yeah, absolutely. I mean, obviously, it depends on the actual thing that they're investing in, but there are private market solutions where you do know by putting money into it, you've made that money available for that next incremental purchase.
All right, Jeff, we really appreciate you coming on today.
Well, thank you. It's been wonderful to be here.
Jeff Shell of BMO Global Asset Management. Wine. People sure love to drink it. But did you know that fine wine as an investment has outperformed global markets this year? To talk more about what's behind the solid returns is Atul Tiwari. He's Chief Executive Officer of Cult Wines Americas, a fine wine collector and investment management firm. Hi, Atul.
Hi, Saijal. Great to see you again. How are
Great to
you?
see you. It's interesting because this is coming at a time when investors are trying to find a place to hide from this broad market sell-off, and fine wine has done pretty well. Tell us about that. And I will bring up a chart, Atul, that shows the performance. But what's behind this?
Yeah, thank you for the question. And you're right. Times are very volatile. Um, Fine wine is doing exactly what it should in these times as a diversifier of portfolios. So fine wine has been shown historically to have low correlations to equities and bonds, low volatility, and what we call low downside capture. So that means if equities go down a lot, wine doesn't go down nearly as much. Um, and what we're seeing year to date, in fact, is that fine wine is increasing. So year to date, returns have been over 14% for the LiveX 1000 index versus, as you point out, S&P 500 down about 18%, gold down 9%. So wine is doing what it should and is also acting as a good hedge for portfolios against these inflationary times that we're seeing.
Yeah, Jill, we had a guest on earlier, Jeff Shell, talking about alternatives, and he said one of the reasons for that is, and especially with collectibles and sort of these private asset classes, is that it's not getting swept away with the market sentiment. Is that what's partly behind the low correlation?
Yeah, that is one of them. The thing about fine wine is it's inherently driven by supply and demand, and so every year there's only a finite amount of investment grade wine that's produced around the world. And with demand staying where it is, and we've seen it stay, in fact, grow over the last few years, there are more individuals, whether they're collectors or consumers or investors chasing that finite amount of wine around the world. And so that insulates the fine wine market to some degree from what we're seeing in the equity markets. In addition, it's a pretty fragmented space. And so you don't have very large institutions or millions of retail investors kind of in and out. The investors in fine wine tend to be people who really do have a long-term view. And when markets do go down, wine is not the first thing that they would think of selling in order to meet cash flow needs, for example.
So, what's your outlook then for fine wine? And you know, when you talk about the supply dynamics and the demand dynamics, what's going to drive it going forward?
Right. A number of factors. As I've mentioned, we're seeing demand increase around the world. We're also seeing more acceptability to pick up on Jeff's comments about alts. There's more acceptability of alts in the retail space as many investors learn that there are some real advantages to alternatives in their portfolios. And as you know, and we know, pensions and other smart investors have been in alts for years. The thing is now they're becoming more accessible, which is great. Um, the other thing is climate change. Regardless of what's happening, the amount of fine wine produced in certain regions every year decreases depending on what we see in the climate. And so if you get early frosts or wildfires or floods in wine producing regions, that may limit the amount of supply coming onto the market. So to answer your question, we see fine wine continuing to appreciate in value. We think that some of the gains that we've seen over the last 2 years will moderate, so that last year there was a 21% return. This year we're on a really good pace. So we expect to see that continue, but there may be some moderation.
Okay. And we only have 15 seconds to the break. Is China still a strong consumer, given what's going on there?
Definitely. And what we're seeing is the Chinese appetite for wine, whether it's for investing or consuming, is broadening out. In the past, it was heavily concentrated in Bordeaux, but we're seeing a lot more interest in Burgundy and Italy.
Welcome back. I'm here with Atul Tiwari, and we've been talking about investing in fine wine. Atul, are certain regions and segments doing better than others, and why? You can explain that.
Yes, Saijal. In fact, just like any other investment, we preach diversification. So you don't want to put all of your bets on one particular region. And so we have an investment committee that sets a benchmark allocation across different fine wine producing regions. So when you look at returns, um, last year, for example, the leading region, the leading sub-index was Champagne, and it was up 41%. The second region was Burgundy, which was up 31% last year. But you can then go down to other regions like, for example, Rhone, where returns were probably more in the 4 to 5% range. So you do want to make sure that your portfolio is diversified so that you can, when certain regions are firing, other ones may not be, and you'll still get a decent return.
Yeah. So explain champagne, because you said last year it did very well. How is it this year, and what's changed in terms of supply dynamics, supply demand, or weather, or whatever it may be?
Yeah, sure. Yeah, Champagne, we saw quite an upswing through the pandemic period. Initially, the producers in Champagne thought people wouldn't want to pop a bottle of champagne while they're sitting at home in lockdown. But as it turned out, more people did, in fact, decide, look, I'm not going to save this for Christmas or my birthday. I'm going to drink it on Wednesday night. And so that combined with supply chain dynamics and adverse weather in Champagne in 2021 resulted in a supply crunch. And we saw the dramatic increase in the Champagne subindex last year, 41%. But we're continuing to see that happen this year. So demand is up. Champagne has really taken a foothold. We're seeing growth in rosé champagne, what are called grower champagnes. These are smaller production compared to the ones that most people see on the shelves, like Veuve Clicquot and others. And so this year, Champagne's performing quite well again. The number one returner is Burgundy at about 28% year to date, and Champagne's close behind at 24% year to date. So both regions have been doing extremely well.
Okay. So a tool for retail investors that are probably watching this, and they want to invest in wine and your company, presumably, where do they start, and what's the minimum investment, if you could go through that?
Right. Yeah. So we're all about making fine wine investment more accessible. I mean, in the past, it had been available to the privileged few, but we want to expand that and democratize it. So we have an offer that starts at $12,500. That's the entry level for a portfolio of wine, and we do match you with actual wine, so you own it. It's segregated, and we manage it for you. The reason we're at the level we're at is what I just talked about, which is diversification. And we believe to get a properly diversified starting core portfolio, it's in and around the range of $12,500.
Okay. And can they pick different portfolios based on their risk tolerance or time horizon?
Yeah, absolutely. So what we do is when a client comes to us, we will do the know your client. We'll understand our client's objectives, duration, risk profile, and then we'll go away and match a portfolio of wine to hopefully achieve the objectives that our client is looking to attain.
Okay. Atul, you were on last in January. How has business been? How are your flows?
Great. Well, as I mentioned, in these volatile times, we're actually seeing a lot of interest in fine wine due to its diversification benefits. So we're having a really good year. In terms of new assets, we're now up over 400 million. I think when we talked, we were probably in and around 300. And we're seeing new assets growing at about 60% plus year over year. Our new client base has increased by 20% year over year.
Yeah.
So overall, these volatile times have really helped us in terms of having investors understand the
Okay.
merits of fine
Atul,
wine.
thanks for coming on today. Really appreciate it.
Thank you, Saijal, and thanks to everyone who's watching.
Well, that wraps up this edition of Strictly Money. Thanks for watching.